In Chapter 4, you learned that disclosure is about known material facts from the seller's perspective. Now we shift into a third-party risk verification tool that often surprises both buyers and sellers, the Insurance History Report, commonly referred to as the CLUE Report. CLUE stands for Comprehensive Loss Underwriting Exchange. This report is not created by the seller. It is generated from insurance claim data and can directly impact insurability, premium cost, and even loan approval. In Arizona contract writing practice, the CLU report is not just an insurance document. It is a risk assessment document that can change the economics of the transaction. What is a CLU report and why it matters in Arizona transactions? A CLU report is a 7-year insurance claims history tied to a specific property and/or individual policyholder. It is maintained by LexisNexis Risk Solutions and used by insurance carriers to evaluate risk. When a buyer applies for homeowners insurance, the carrier often pulls a CLU report automatically. Phoenix example: a buyer is under contract in Chandler. During the insurance application process, the insurer discovers 3 prior water damage claims in the last 5 years. The buyer's premium increases significantly, and the carrier requests documentation of repairs. This may occur even if the current seller has not experienced a recent issue. This means claim history follows the property in practical underwriting terms, even though the report is technically tied to prior insured parties. How CLU connects to seller disclosure and SPDS. The SPDS asks sellers about prior water damage, roof issues, fire damage, and insurance claims. The CLU report becomes a verification tool. If a seller discloses no prior water damage, but the CLU shows multiple water-related claims, that discrepancy can trigger renegotiation, credibility concerns, or cancellation. Arizona practice point: the seller is required to disclose known material facts. The CLU report is not a substitute for disclosure. However, inconsistencies between disclosure and insurance history can create serious transaction risk. Gilbert example: seller discloses no roof leaks. CLU report shows a paid roof leak claim 2 years prior. The buyer now questions whether repairs were properly completed. The issue shifts from repair cost to trust and transparency. What appears on a CLU report. A typical CLU property report may include type of loss, water, fire, wind, theft, liability, etc. Date of loss, claim amount paid, claim status, closed, open, denied. Insurance company involved. It does not include routine maintenance. It reflects insurance claims filed. This distinction matters in contract writing. A minor leak repaired out of pocket will not appear. A filed claim almost always will. Why insurance history affects financing and closing. Most lenders require homeowners insurance before funding. If the CLU report reveals multiple losses, buyers may be denied coverage by one carrier, face higher premiums, be required to obtain specialty coverage, be required to provide proof of completed repairs. Scottsdale example: a luxury home with prior fire and water claims may require underwriting review before coverage approval. If insurance cannot be secured within contract timelines, the buyer may have a contractual basis to cancel under insurance contingency provisions. This makes early insurance investigation a strategic move, not a last-minute task. Seller strategy. Should sellers obtain a CLU report before listing? Sellers can request their own CLU report from LexisNexis to review accuracy before listing. Errors occasionally occur. Reviewing the report allows sellers to prepare documentation of completed repairs and avoid surprises during escrow. Professional best practice. In high-risk properties with prior claims, proactive transparency reduces late-stage renegotiation. Broker role and risk management licensees do not order CLU reports for buyers unless specifically authorized and coordinated appropriately. However, brokers should encourage buyers to apply for insurance early in the inspection period. Educate sellers that insurance history may surface during underwriting. Avoid making representations about insurability. This ties back to ARS, Paragraph 32-2153, regarding misrepresentation, and AAC, R4 28-1101, concerning reasonable skill and care. Statements like, insurance will be no problem, can create liability if incorrect. Clue versus inspection versus disclosure. 3 different tools. Inspection reveals physical condition. SPDS reveals seller knowledge. Clue reveals insurance claim history. Together, they create a risk profile. None replaces the other. Arizona brokerage scenario. Real-time risk management ABC Realty lists a home in Mesa. Seller had a kitchen water leak 3 years ago and filed a claim. Repairs were completed professionally. The seller discloses the prior water damage and attaches invoices. Buyer's insurance carrier pulls Clue, confirms the claim, reviews documentation, and issues coverage without issue. Because disclosure matched claim history, there was no renegotiation. Transparency preserved deal stability. Course discussions with answers. Discussion question. Why can a Clue report create transaction risk even if the current seller had nothing to do with past claims? Answer. Because insurance underwriting evaluates property loss history regardless of ownership, and multiple prior claims can affect insurability, premium cost, or lender approval. Discussion. Question. If a seller discloses no prior water damage but a Clue report shows multiple water claims, what risk does this create? Answer. It creates credibility concerns, potential misrepresentation allegations, renegotiation, and possible cancellation if the buyer believes material information was withheld. Discussion. Question. Why should buyers apply for homeowners insurance early in the inspection period? Answer. Because insurance underwriting may reveal claim history issues that affect coverage, cost, or approval, and early discovery preserves contractual options within contingency timelines.